This was not just a war fought in trenches. It wasn't only about artillery fire, barbed wire, and bayonets either. The First World War was also a war fought with money. It was a struggle that unfolded in gold reserves, in bond markets, and in the corridors of central banks. While soldiers were bleeding on the front lines, others were sitting in offices running calculations. Financiers, bankers, and government officials, many of whom never set foot on a battlefield, were studying balance sheets and trying to determine how long their countries could endure. The financial decisions made in those years did not just determine who won and who lost. They helped shape the global economic system we are still living in today. If you think war is only about politics and armies, it may be worth stepping back and looking again. Because the First World War showed us that money is also a weapon, and sometimes the most powerful one. Welcome to Stories Behind the Money, where power, ambition, and history collide, and every fortune has a hidden cost. When we go back to 1914, Europe was already tense. Nations didn't trust one another, alliances were forming, and empires were flexing their strength. Everyone sensed that something was about to break. But there was something most people didn't fully realize. A war on this scale required unimaginable amounts of money. Leaders who chose war were also choosing debt. Every soldier marching to the front represented not just a military decision, but an economic burden that would last for years. Still, at the beginning, many governments believed the war would be short. It might be over by Christmas, they said. They assumed they could pay for it the old-fashioned way, with gold, limited borrowing, and patriotic donations. That illusion collapsed quickly. War was burning money at a speed no one had anticipated. At the time, Europe's financial system was largely tied to the gold standard. Governments promised that the paper money they issued could be exchanged for real gold. That gave currencies credibility, but it also limited what governments could do. Gold was finite. You couldn't just print endlessly without risking a loss of trust from both citizens and creditors. Britain, France, and Germany all began with respectable gold reserves. But once millions of men were mobilized and factories shifted to producing weapons, costs soared. By late 1914, Germany was spending more than 10 million marks per day. Britain's daily war costs soon reached £2.5 million. The math was simple and brutal. The gold would not last. So governments began suspending the rules. One by one, they moved away from the gold standard. They didn't always announce it clearly, but the reality was this: money was no longer anchored to gold. It was anchored to trust in the state. This marked one of the biggest turning points in modern financial history. The link between money and tangible value had been broken. Now currency was supported not by metal, but by belief. And once governments experienced that flexibility, they had little desire to go back. Germany faced especially harsh conditions. Blockaded at sea and cut off from global capital markets, it had limited access to foreign borrowing. So it turned inward. Massive war bond campaigns were launched. Citizens were urged to lend their savings to the state. Posters, speeches, and propaganda appeared everywhere. The message was constant: give now, and you will be repaid after victory. Many people responded out of patriotism and invested their savings. In total, hundreds of billions of marks were raised, but the entire system depended on victory. When defeat came, those bonds became worthless. Millions of people lost their life savings. That economic devastation fed resentment and instability in the years that followed. Financial trauma can leave deep marks on a society. Britain, meanwhile, stood in a different position. London was the financial center of the world. The pound was trusted. Global trade networks were strong. At first, the government relied on short-term borrowing and treasury bills, but soon it needed deeper resources and turned to the United States. America was officially neutral at the time, but its bankers saw an opportunity. American banks provided massive loans to Britain and France. They financed purchases of weapons, food, and raw materials. Even before the United States entered the war militarily, it was already deeply involved financially. This support wasn't just about helping allies, it also brought enormous influence. By the end of the war, the United States had transformed from a debtor nation into the world's largest creditor. The beginning of what became the American century was written not just on battlefields, but in financial ledgers. France faced similar challenges. The government encouraged citizens to buy war bonds, and many did. But a significant portion of the deeper funding still came from the United States. This growing dependency would later shape political tensions, as debts piled up and repayment became a major issue after the war. Russia's situation was far more fragile. Its economy was underdeveloped, and its financial system was weak. As war costs rose, borrowing increased, inflation surged, and confidence in the currency eroded. By 1917, the economy was collapsing, and public trust in the government had largely vanished. The fall of the Tsarist regime was driven not only by political factors, but also by financial breakdown. When the monetary system failed, the political system followed. By the end of the war, the sums spent were staggering. The Allied powers spent hundreds of billions of dollars. These amounts far exceeded pre-war economic levels. The result was massive debt, widespread inflation, and the collapse of the old financial order. Germany soon experienced one of the most extreme hyperinflations in history. People carried bags of money just to buy bread. Savers lost their wealth. Small investors suffered. The wealthy, meanwhile, often found ways to protect themselves, moving assets abroad, buying real goods, or staying close to centers of power where information arrived first. The lesson was clear. In financial crises, ordinary people often bear the greatest burden. The First World War taught governments something important. The monetary system could be stretched. The gold standard could be abandoned. More money could be printed. Bonds could be issued. Debts could be postponed. And all of this could be done while reassuring the public that it was temporary. These methods did not disappear after the war. From the Great Depression to the financial crisis of 2008, similar patterns have appeared again and again. When the war ended, the world had changed dramatically. The United States held the largest creditor position. Europe was drowning in debt. Britain and France tried to recover their losses by demanding reparations from Germany. But Germany could not realistically pay. Economic instability deepened. The crises of the 1920s laid the groundwork for future political upheaval. Britain also made difficult choices in its attempt to restore its former financial strength. In 1925, it returned to the gold standard at the old pre-war value. But the economy was not ready. The result was deflation, unemployment, and social unrest. Once again, ordinary people paid the price. The United States, meanwhile, had financial strength. It lent money to Europe, and Europe used that money to pay each other. On the surface, the system looked functional. In reality, it was fragile. When the Great Depression hit in 1929, the entire structure collapsed. The world had become financially interconnected, and that made the crisis global. All of this reminds us that the First World War was not only a military turning point, it was also a financial one. It demonstrated how governments could reshape monetary systems. It showed how debt could be framed as patriotism, And it revealed that those who benefit most from war are not always the ones fighting it. Looking at today, some patterns feel familiar. We hear that inflation is temporary. We see rising debt. We see money created digitally. None of this is entirely new. Similar dynamics existed more than a century ago. That's why looking back at history matters, because the same mistakes can happen again. Real wealth is not just numbers in a bank account. It is knowledge, awareness, and resilience. History teaches us that monetary systems can change, and currencies can lose value. But understanding how these systems work can help people navigate uncertainty. And perhaps the most important thing to remember is this: history does not repeat itself exactly, but it often rhymes. Those in positions of power tend to protect themselves. Those without information often bear the consequences. That is why it is important to question economic narratives, to learn from the past, and to stay aware. Because the truth is often hidden in balance sheets. And history, for those willing to look closely, always has something to teach. If this video gave you a different perspective, subscribe! Because history doesn't hide the answers. It only reveals them to those who know how to look.